Troy Sharpe here, CEO of Oak Harvest Financial Group, along with Chris Perras, our Chief Investment Officer. And today we're going to talk to you about a range of possible outcomes that the stock market could go from here. But first, today is a very big day in Texas because it's April 30th, and that means tomorrow we have the Phase 1 reopening where retail shops, restaurants, and movie theaters will reopen subject to a 25% capacity. So that's really good news. We're excited to see where that goes. Hopefully we have a very positive experience, and that leads to more of the economy, not just locally, but nationally, reopening. Before we get into the range of possible outcomes today, I want to point you back to the very first video we did in this series. It's on YouTube. It was around March 23rd we put it out. And Chris, we were talking about healing signs behind the scenes in the stock market. And this was when fear was gripping the nation. This was when fear and panic was setting in the stock market. That we saw a lot of capitulation, investors getting out of the market. But yet we sat here and we talked to everyone about the positive signs that we were seeing behind the market. And since then, the market has been up 30%, a little more than 30% actually. And in the last video in this series, we talked about how the stock market always recovers before the economy. So I just want to drive that point home first, because we are going to have some bad economic news over the next couple of months. So Chris, where do we see over the next couple of months, let's say, what is the best case scenario through the summer?
Well, best case scenario is we come up with a vaccine before everyone thinks. With the backdrop of Federal Reserve increasing their balance sheet upwards of 50% year over year, we would regain the all-time highs and hit new all-time highs later this year, probably near the election, because there would be so much liquidity in the market and economic revival because there's pent-up demand for goods and services out there.
And when we heard people on TV, just 3, 4, 5 weeks ago, it's a Great Depression, the country's gonna, the sky is falling, get your money out of stocks, do all this. And now those same people on television are saying, you can't fight the Fed, there's all this liquidity in the marketplace. Again, we've been telling you, our clients, don't listen to the people on television. They have a vested interest in scaring you and making you afraid, so you continue to tune in. But the whole purpose of these podcasts, the podcast that you do, these YouTube videos that we're putting out, is to help you get more connected to your money and understand that there are things going on behind the scenes that we see on a daily basis, that we're monitoring, that do give us confidence with the decisions we're making, with the investments that we're putting in place. And they're positioned to take advantage of what's going to happen in the marketplace 3 months from now, 6 months from now, 12 months from now. But when we look at if we do get a vaccination, or if we have some type of positive treatment with the coronavirus, and then also if we have a successful reopening of the economy. These are all things that, with the liquidity in the marketplace from the Federal Reserve, could cause the market to very easily hit all-time new highs in a much more rapid fashion than many of these people on television and radio are saying.
For sure. We've actually seen a very specific group of stocks in the market hit new all-time highs. Those stocks that were helped by the shutdown, stocks that deal with telecommunications and you working at home, those have been positively affected. The restaurant stocks obviously have been negative affected, but people want to go back. They want to eat out. Before the virus hit, we were eating 40 to 50% of our meals at restaurants. That's gone down to under 5%. It may not go back to 50% for years, but I know my wife's making reservations for 3 weeks out at our favorite restaurant with the hopes it reopens. So there's pent-up demand for goods and services out there.
And the reaction that the federal government, the Federal Reserve, compared to the economic circumstances back in 1929 with the Great Depression, the response, it's been 10 times more swift, and it's also been in magnitude, it's been 10 times greater. Do you see any chance that this spirals into some type of depression at all, like you hear on TV all the time?
I didn't live through the Great Depression. My dad actually is still living. He was a newborn through 7 years old and talks about living through the Great Depression and food lines and the rest. Researched it a little bit, and the reason we went through the Great Depression was our president, Herbert Hoover, was anti-government help. So for 3 years, we did nothing. We didn't try to expand the economy. We didn't try to help the unemployed. It took us 4 weeks, 6 weeks this time to throw 10 times as much money at the problem as we had in 2008, 2009. and for the government to react. And we've reacted very quickly. Obviously, it's reflected in the stock market very quickly. This morning, I think the stock market hit 2950 on the S&P 500, which is where it was for a long time last year. We were talking about it this morning. I think in July of last year, it was 2950. In September, it was 2950. So this is a level on the stock market that we've been for a couple years. When the economy starts to pick up, which it will, and it doesn't have to get back to the normal that we were in before the virus, we will adjust, just like we adjusted after 9/11 to a normal then by way of flying. We'll adjust to a new normal. We're very flexible as a nation and as an economy.
So when we look at what the Federal Reserve has done, essentially they have increased their balance sheet by over 60%. So this is trillions of dollars going directly into the economy. And this creates a floor in the stock market. And it helps businesses, it helps individuals, it helps people, because that money flows through the banks and gets into the financial system. And the old saying, don't fight the Fed, has really never been so true. Whether this recovery takes 6 weeks, 6 months, or a couple of years, it's our firm belief that the market is going to go a lot higher from where it is today. It's just really a matter of timing as opposed to anything else. So the best case scenario, going into the election, we are at all-time new highs, blowing through the previous highs. We don't see a depression coming because of so much support from the Federal Reserve, and we believe in America. We believe in our scientists, our healthcare workers. The social distancing has been working, so not nearly as much downside in fear as maybe there was just a month ago. But what is probably to be expected? What should our clients expect over the next 2 to 3 months from our perspective?
So what would be normal, and outside of the massive volatility that we've had since February, this has been a very normal year as far as seasonality to the stock market. We've seen a big recovery here into the end of April, beginning of May. That is very normal. The strongest part of the stock market is usually from October through April. Outside of this virus, we were at new all-time highs in February. We've had a big recovery. So normally what happens is the second and third quarter are normally higher volatility months in the stock market, slower economic activity because of the summer. You could expect the same thing this year with regards to the stock market because there's even more uncertainty than normal for summer. So, a pullback this summer from say 3,000 back down to 2,650 or 2,700, which is essentially where we were a couple weeks ago, not out of the realm of possibilities. And we will be looking for opportunities if that happens to buy stocks and to continue to shift portfolios for an outlook of an improving economy in the second half of this year.
One of the things that I've seen, so when in talking to clients, when the market was going down, on the phone, you get a sense of fear, obviously. Now, more recently, what I've been sensing is, I don't want to use the word greed, but it's we need to get in, we need to get invested, we need to do this right now. So I want to stress that as professional investors, as people who are responsible for managing the wealth of a lot of people, we don't look at investing in terms of days or weeks. We're trying to position the portfolio the best we can over for long periods of time. And the market is not going to go up in a linear fashion from here. We will have pullbacks over the summer. This is not the floor necessarily. We very well could see a 2, 3, 4, 5, maybe even 10% possible pullback. And we want to be emotionally prepared for that because it could happen. But it's not going to go just straight up from here, almost certainly. So still being patient, being methodical, having discipline, sticking to our process and our approach is the best method for achieving better long-term returns. And we do see the stock market probably moving sideways for a couple of months, so we do want you to be prepared for that. The news, be prepared. The news is going to be horrible over the next couple of months. So the first quarter economic earnings that are coming out, we had 2 good months before the economy was really shut down the third month in the first quarter in March. So now when we have the Q2 earnings come out, they're going to be disastrous. So the news headlines over the next couple of months are going to be, fire and brimstone, the sky is falling, this is the worst economic news ever. But remember, the stock market knows this. We know this. This is not going to be news to anyone who's paying attention and has any significance in the stock market. We'll see some day-to-day volatility, of course. Don't be afraid of that. That is going to happen. But the stock market understands that these numbers are going to be bad. It would already be priced into the stock market. As a matter of fact, I think I heard Powell, the Fed chairman, say yesterday that this is going to be the worst economic news ever. We are virtually going to have the worst economy ever when these reports come out over the next couple of months, Q2 earnings. So people should be aware of that. That's why we don't think the market is going to go straight up in a linear fashion from here, but we need to be patient. It should move sideways, which presents a tremendous amount of opportunity to get money invested, to reposition into sectors and parts of the economy that will do real well. And we do expect the second half of this year to be very strong.
Yep. We've actually already seen some things anecdotally that say there's pent-up demand out there. I know I live right around here in Memorial, and the real estate market here in Memorial had started to pick up pretty dramatically in January and February for the houses that were flooded by Harvey, and they sat empty or renovated for almost 2 years. But millennials started coming in at the beginning of the year and buying those houses. Well, that obviously shut off for a month, 6 weeks. And just in the last couple of weeks, I've seen another couple houses that said sale pending. I don't know if it's because they've all reached the age where they have kids between the ages of 2 and 8 years old, and they want the schools, or if it's because they don't want to live in an apartment and they're afraid of being socially near all these other people, and they say, hey, I want to own a house, so I move away from all these people. But I just know, housing is already starting to gain footing again, and that's a big part of the economy.
Yeah. So, and we had the best housing report in years in
February.
Yep. I believe 20% new home sales growth. So, underlying, we had an amazing economy before this happened. This has been a big setback economically, obviously, and we expect some gyrations in the market moving forward, but at the same time, we're taking a disciplined approach, and we do believe that we will come out of this much stronger on the other side, and we've been saying that for over a month now. So if you have any questions, reach out to us. We're here for you. We're going to keep doing these videos, keeping you connected to your money. And Chris, I want to thank you very much for your time this morning, and we'll see you very soon.